If you're wanting to build a property portfolio that replaces your full-time income and lets you retire early, this is a video for you. Today we'll run through a scenario of what it could look like for an average Australian couple to replace their income and retire within 20 years, all through property investing. We're going to run through an example using average wages, long-term property data, and other calculated assumptions to accurately model a realistic portfolio strategy. This is about showing the big picture of how property can work as a long-term wealth building tool, not a get-rich-quick scheme. My name is Nicholas Allen. I'm a mortgage broker with Kingfisher Finance Group. We're a boutique brokerage that specializes in helping property investors build wealth strategically and have over 120 five-star Google reviews to back it up. If you're looking for an investment-focused brokerage, you can book a chat with us down below. Now let's get into the scenario. Before we dive in, just a quick disclaimer. What I'm sharing today is for general education only. It's not financial, tax, or legal advice. I haven't considered your personal situations, so don't act on this without getting advice that's specific to you. Property markets can go up and down, and past performance doesn't guarantee future results. If you'd like tailored advice around financing or lending, feel free to reach out to me directly. So in this scenario, we're looking at a couple with one dependent, each earning about 100k per year, which is approximately the average full-time salary currently in Australia. We're assuming that there's no other debts or liabilities in this scenario, and we're also assuming that this couple will be rent vesting so they can maximize their borrowing capacity for investing. We also will be ignoring offset accounts for this, just for simplicity. The assumptions that we've made for these calculations: we're using a 2.7% annual income growth as per ABS wage price index. We're using a 6.8% annual capital growth, which is based on data from the past 25 years for houses. We're using a 6% interest rate continuous, unless otherwise specified. We'll be using 3% inflation for all holding costs and expenses. We'll be using a 4% annual rental increase. We're ignoring depreciation in this case. We're assuming all properties will be paid at market value. I know some other scenarios people might raise, they'll be assuming you'll be getting a discount on the way into the property and getting instant equity. In this case, we're just going to assume you're paying market value and all equity is created through growth. We'll also be using interest-only loans for the entire time to sort of maximize our cash flow while we're building the portfolio. For the financial breakdown, so again, each earning 100k, this is assumed to be between 75,000 and 80,000 after tax. So their total after tax income is between 150 and 160,000 combined. The HEM, which is a household expenditure measure, we're approximating about $5,000 per month that they're spending on general living, which equates to $60,000 per year. And on top of that, they're also renting for $800 a week. Now this $800 a week, depending on the yield, will get you a property that's worth between 1 to 1.3 million usually. So they're still living in a pretty nice property while they're renting. And this equates to about 41,000 per year. And in the calculations, this will also increase at the standard rate to account for that. We're also putting aside $1,000 per month just for extra expenses, discretionary or not, and that's just a little buffer so we're not using up all the income. So we can see by this, the total net income required is a little over 100k, which leaves them anywhere between 36 to 46,000 that they have ready to invest. Now, for their financial goals, our goals is to replace their current income with passive income within 20 years. So if you look at the after-tax dollars of $150,000, adjusted for inflation, this would be $244,000 in the year 2045. With the current tax rate, this requires a bit over 300k to achieve this target as gross income. And if we're assuming a net yield of 5%, this means we need about $6.5 million portfolio. Or if we assume a net yield of 6%, you need about $5.5 million portfolio. So really, to achieve this income goal, we need to figure out what sort of portfolio value is required which if we're aiming for a yield of 5 to 6%, we need to build a portfolio that's paid off that's between $5.5 and $6.5 million. So that's the sort of goal that we'll be working towards to build that portfolio size. All right, so with the current year, again, personal income, 100K each. With this scenario, their borrowing capacity with major like first tier lenders is about 900K to $1 million. So what we're going to do is we're going to purchase property 1. We're purchasing this for 800K and we're assuming a rental yield of 4.5%, which is about $700 per week. The deposit we're using for this first property, we're assuming they've been able to get together a 20% deposit plus purchase costs, which is nearly 200K. Now you don't need to have a 20% deposit, you can get in earlier, but we've done this just so they're growing equity from day one. If you were to get in with a smaller deposit, you might just have to wait that extra year for the equity to grow before you can access it. Or you pay LMI to be able to access that equity. Now this property we purchased with the goal of capital growth, so the cash flow isn't too much of a concern. It's going to be negatively geared and we're just going to be harvesting the equity for future deposits on other properties. So now we fast forward 2 years to 2027, the income will have grown by roughly $5,000 each. And now we're going to look at using third tier lenders to get that slightly bigger borrowing capacity to get a second property. So this property will also be purchased at 800K with the same rental yield of 4.5%, so about $700 a week. This time we're going to use a 12% deposit plus LMI and purchase costs, which ends up being about $132,000. And this will be made up of about a $90,000 equity release from property 1 and $42,000 in savings, which I would have been able to save over the last 2 years. And if we look at the bottom down here, you can see property 1's grown in value. The mortgage balances remain the same because we're paying interest-only loans. We're not paying down that principal. You see our equity has grown to nearly $90,000, and that's what we're going to extract and use as part of the deposit for property 2. You'll also note that property 2 is being purchased within a trust, and this is just for future-proofing our portfolio to be able to get a bit more borrowing capacity in the future, but I'll go on to that a bit later on. So another 2 years down the track, so now we're at 2029, the personal income will have grown to about $111,000 each, and we're looking at purchasing property 3. So you notice we're not purchasing a property every year or purchasing multiple properties a year. We're sort of purchasing a property once every 2 years at this rate. And that's just because we were allowing that equity to grow at that standard rate of 6.8%. Now, obviously property doesn't always grow in a linear fashion. It's not going to be 6.8% year on year on year. There'll be higher periods and lower periods. But for the sake of a 20-year plan, we can assume it's going to average out to about that amount. So this property will also be a property that will be used for capital growth. And we're also buying this at a value of about $800,000. The same rental yield as the previous ones and the same deposit of $132,000, which is a 12% deposit. This time we're going to be pulling out another $100,000 from property 1 and $32,000 from savings, which they would have been able to save over the last 2 years. All right, another 2 years down the track, 2031, personal income's grown a bit more. Now we're looking at purchasing property number 4. So property number 4, we're going to purchase at that 900K price point. But this is going to be a cash flow focused asset. So it's going to have a much better rental yield of about 7%. So this 7% rental yield will get about $1,200 a week. And the deposit we'll be using this will be close to 150K. And again, that's a 12% deposit plus LMI and purchase costs. So this 150K is going to be coming from equity from property 1 and 2 as it's grown over the last 2 years. We'll also note that this is actually being purchased initially with a slightly higher interest rate of 8%. And that's just due to the nature of this purchase and the lender that it will probably be used. So as mentioned, it's going to be a cash flow asset, which is why it's actually highlighted green to differentiate the cash flow assets from the growth assets. And you'll note that this property is also being purchased in a trust. And there's many reasons for this. One is for our future borrowing capacity to be able to grow a bigger portfolio. And also having your cash flow assets in a trust gives you a bit more flexibility with the distribution of funds in the future when they're positively geared. Now we're jumping 3 years in the future. We go on to 2034. Our personal incomes are $127,000 each roughly. We would have refinanced property 4 to be at much lower interest rate back to about 6%. and now it's actually going to be positive cash flow. And we're going to go try to purchase property number 5. So property number 5 will be very similar to property number 4, purchasing at that 900k price point with a 7% rental yield at $1,200 a week, with the same deposit, which is going to be as an equity release from property 3. So we'll see property 1, 2, and 3 are still growing in equity. They're all negatively geared, which is okay. Property 4, because it's positively geared, you'll note we've actually excluded it from servicing, and that's because some lenders, if the property is within a trust with a corporate trustee, and that trust is servicing itself with cash flow wise, meaning you're not having to put any money into the trust to hold on to that property, some lenders will actually exclude that debt completely, meaning we can extend our borrowing capacity a little bit further. So in this scenario, when they've gone to buy property 5, they've looked at the debt that they've got on property 1, 2, and 3, but they've ignored property 4 and obviously accounted for the debt that's going to be on property 5. And again, this one initially we purchased with a slightly higher interest rate, meaning it'll be cash flow negative. But as we grow a bit of equity and get in a slightly better position over the next year or two, we'll refinance that to a better position of about 6% interest rate, where we'll then be positively geared and be able to do the same thing as property 4 and exclude that from servicing. So another couple of years in the future, we're in 2036. Personal income's growing a bit more again. What we've done is we've refinanced property 5 to roughly like a 7% interest rate. And what that's done is got us to a neutral cash flow on that property, meaning we can exclude that from servicing. And we're going to look at purchasing property 6. So this one's going to be a slightly bigger asset of about $1 million, but also aiming for that 7% rental yield, which ends up being a bit over $1,300 a week. So you'll see here as well, property 3 is now being sold. This is one of our growth assets that we bought. The reason we're selling that is we wanted to take our profits. You'll see after the sale, clearing the mortgage, paying any capital gains tax, we're going to get about $275,000 left. And this also clears up the debt and gives us that cash to move forward. Whereas if we're holding on to property 3, we would be unlikely to be able to extend and get even more debt. So freeing up this debt and this cash allows us to go buy property 6. And because we've got a bit more cash this time, we're actually buying it with a full 20% deposit, meaning we're getting a better interest rate, and it's also going to be cash flow positive from day one. Now we're going to pick up the pace of our acquisitions. This is 1 year in the future. Personal income's a tiny bit higher. We're refinancing property 5 down to a 6% interest rate to get the best cash flow possible. And we're looking at purchasing property 7 also for $1 million. Again, aiming for that 7% rental yield, a bit over $1,300 a week with a full 20% deposit. And this deposit now is coming from property 1. As we haven't touched property 1 for a few years now, there's been a lot of equity. You'll see here we've got over $500,000 in usable equity, and we're going to do that almost full $500,000 equity release there. So half of that is gone to property 7, which we're buying in a trust. You'll see now property 4, 5, 6, and 7 are all purchased in trusts and all have that positive cash flow. So now when we look for further acquisitions on properties in the future, that debt can essentially be excluded depending on the lender we look at, and they're only looking at property 1 and property 2 and whatever property's next. So it gives us a lot more flexibility to extend our debt to buy more assets essentially. So in that same year, we've still got that other half of the 500k equity release. We're looking to buy property number 8. Now this one's also going to be about $1 million, but this one's going to be another growth asset. So we've got 4 cash flow assets. We had 3 growth assets. We sold one and we've picked up another one now. So this one will be using a full 20% deposit using that other half of the 500k that we released earlier, meaning we're going to have an 80% LVR, be at the best interest rates, and be growing usable equity from day one. Now, we're going to let the portfolio sit for a couple of years, let the growth assets grow, so we have more equity again in the future. Our income's also growing. So now, over the last few years, for this scenario, what I've done is actually pay down property 2 a little bit to get that to a neutral cash flow point. And because it's in a trust, we can exclude that from servicing as well. So if you look at our 4 cash flow properties, as well as property number 2, they're all within trusts. They're all either neutral or positively geared, and we can exclude all that debt. So then we're going to look at purchasing property 9 for $1.2 million now. The rental yield will probably be about 4% on this asset, which we'll say is $900 a week or $920 a week. The deposit for this will be about $300,000, which is a 20% deposit plus purchase costs. And this $300,000 will all be coming from property 1. You'll also notice that property 8 and 9 are not purchased in trusts. And that's because these are purely for growth. They're probably not going to be positively geared while we hold them. And they're also going to be sold in the future. So there's not any benefit for us holding these in trusts. Now we get to 2045. This is sort of after 20 years. Our personal income's growing to 170K each. We're looking at selling all of our growth assets now. They've done their bit. We're going to exit and take as much money as we can. So that's property 1, 2, 8 and 9. And with all these sale proceeds, we're going to look at paying out the debt on our 4 cash flow properties. So the total funds after these sales is approximately 3.4 million, and the total debt remaining is about 3.2 million, and we're left with about 180 grand at the end of it. So if you look at our overview of 2045, all of the debt on the cash flow properties are now paid off, and now these people are either retired or have the ability to retire due to that passive income goal that they've achieved. Now, the original passive income goal was about 150K after tax, and adjusted for inflation, we're looking at 244,000. Now, if we look at the actual after-tax passive income we've actually achieved about $245,000, and the gross passive income, which is before tax, is nearly $330,000 per year, with a total portfolio value of 6.3 million. Which, if you remember from the start, we were looking between a 5.5 million and a $6.5 million portfolio to be able to get the cash flow that we needed. So I hope this gave you a good overview of what's possible in growing a portfolio to replace your income. Now, obviously, these numbers were very generic, so not all properties are going to perform like this. Some might be better, some might be worse, but it gives you a general idea of what you can achieve using the average numbers of property growth. Now, if you're a savvy investor, you know where to buy. You can actually accelerate this plan. If you're buying in areas that are growing at 10% year on year or even 15% year on year, you're going to be able to grow that equity much quicker to purchase the properties quicker. And potentially, instead of holding on to the growth assets for a full 15, 20 years, you're holding on to it for 5 or 10, selling and buying in a different market and getting that accelerated growth. Again, this is just a very general scenario with general numbers to show you what's possible. Now, if you're curious to how I actually put all these numbers together and figured out all these calculations, we developed a spreadsheet that's called the Investor's Blueprint. This allows you to input your property purchase, forecast all the numbers over a 20-year period, and you can input up to 10 properties in the spreadsheet to see what the cash flow, the growth, and everything looks like over a 20-year period. Now, this spreadsheet is actually free for everyone to use, and you can download that down below. As mentioned, I'm Nicholas Allen from Kingfisher Finance Group, and if you'd like to have a chat to me, you can book a free strategy session call with me. We can go through your numbers and see what's possible for your situation. Thanks for watching this video, and I hope it gave you a real insight to see what's possible with investing in property in Australia.